Have you ever really thought about what keeps the money in your bank account safe? I mean, it's not just a big metal vault, right? It's actually this complex, pretty much invisible fortress of rules and regulations. And it's not just protecting your money, it's designed to protect our entire economy. So let's take a look at how that fortress is actually built.
Okay, think about it. You deposit your salary. It's a simple act, something we do all the time without a second thought. But right there, in that simple transaction, lies the central challenge of all banking. See, for you, that deposit is cash. It's yours, and you want it back whenever you ask for it. But for the bank, well, it has very different plans for your money.
And this right here is the fundamental mismatch that makes the whole business of banking kind of fragile. The bank's liabilities, that's your deposits, are super short-term, but its assets, the loans it makes for homes or businesses, are locked in for years. So what happens if everyone asks for their money back at the same time? Well, even a perfectly healthy bank can't pay. And that fragility is exactly why regulation is so absolutely crucial.
So this brings us right to the core of the issue. Banking, at its heart, runs on trust. And when that trust breaks, it doesn't just hurt one bank. No, it can threaten the entire system. And preventing that is what regulators are trying to do. The big, scary thing that keeps regulators up at night is something called systemic risk. You can think of it like a financial pandemic. One sick bank gets into trouble, and suddenly it infects others, creating a wave of panic that spreads through the whole economy. We saw it happen during the Great Depression. We saw it again in 2008. It's not just about a single bank failing. It's about the entire economic engine grinding to a halt.
So how does this actually happen? Well, it starts small, but fear is incredibly contagious. A run on one bank spooks the depositors at other perfectly healthy banks. So they rush to pull out their cash, and pretty soon, those healthy banks are facing a crisis of their own. It just creates this cascade of failures. So the big question is, who's there to stop these dominoes from falling?
Well, let's meet the architects and the guards of this financial fortress. In India, this whole system didn't just appear out of thin air. It evolved, piece by piece, and usually in direct response to some kind of crisis.
In the very beginning, things were pretty informal. Banks basically relied on mutual trust to clear checks through what were called clearinghouses. But as you can imagine, informal trust wasn't enough. After the huge shocks of the Great Depression, it became clear we needed a lender of last resort, a central authority that could step in with emergency cash. And that led to the creation of the Reserve Bank of India. But this also creates a really tricky balancing act, right? If banks know there's a safety net, does it make them want to take bigger risks? It's a debate regulators are always having. Finally, in 1949, the Banking Regulation Act came along and gave the RBI the formal legal power to lay down the law.
Now, the RBI isn't in this alone. It's the main guardian, for sure, but it works with the central government, with specialized bodies like NABARD for rural banks, and it even pays attention to international organizations that set global standards. They're all working together to keep the system stable.
So how does this fortress actually work? Well, the very first line of defense is the front gate itself. You see, not just anyone can decide to open a bank. You need a license, and getting one is incredibly difficult, and for a very good reason.
The RBI acts as a really strict gatekeeper. Before it even thinks about handing out a license, it needs proof. Can you pay back every single depositor? Is your financial structure solid? And, this is a big one, is your management team trustworthy? Are they actually acting in the public's best interest? It's a really high bar, and it's designed to keep the bad actors out from the very start.
Okay, so let's say a bank makes it inside the fortress. Now, it has to live by a very strict set of rules. And this isn't just about money. It's about good governance and making sure the people in charge don't abuse their power.
The goal here is pretty simple, really. Make sure the bank is run for the benefit of its depositors, not its owners or directors. And to do that, the regulations get very, very specific about who can be in charge and what they can, and more importantly, cannot do.
These rules are all about stopping conflicts of interest in their tracks. For example, no single shareholder can have too much power. A bank is flat out forbidden from just giving a loan to one of its own directors. The majority of the board has to have real technical expertise. And the RBI gets the final say on who gets the top jobs. It's all designed to keep the management focused on keeping the bank stable, not on personal gain.
But look, even with the best management, crises can still happen. And that's why the fortress has these built-in emergency systems. Think of them like financial fire extinguishers, to make sure a bank never runs out of cash when depositors start showing up.
So a bank can't just lend out every single rupee you deposit. The regulator basically steps in and says, whoa, hold on.
A chunk of that money, called the cash reserve ratio, or CRR, has to be parked with us at the RBI as a safety buffer. It's like a mandatory emergency fund that can't be touched. Then, another slice, the statutory liquidity ratio, or SLR, has to be invested in super safe, easy-to-sell things like government bonds. Only what's left over can actually be used for loans. This whole setup makes sure there's always a pool of cash ready to go in an emergency.
And this gets to a really crucial point. These rules aren't just about accounting, they're about psychology. Managing liquidity is really about managing confidence. Because if you, the depositor, believe your money is safe, you won't rush to withdraw it. And that prevents the very bank run these rules were designed to stop in the first place.
So the obvious next question is, what happens when a bank doesn't follow these rules? Well, the guardians of the fortress don't just ask nicely. They have a pretty powerful arsenal to make sure everyone stays in line.
Yeah, the consequences for breaking the rules are meant to be a serious deterrent. Let's just say they start small, but they can escalate all the way up to what is essentially a corporate death sentence. The RBI can start by imposing restrictions, like telling a bank it can't open any new branches. Then come the really heavy fines. If the problems keep going, the RBI has the power to literally fire the CEO and take over the board. And in the most extreme cases, it can just cancel the bank's license entirely and shut it down for good. That is the ultimate power that keeps the entire system in check.
So after looking at all these different layers of defense, the tough licensing, the governance rules, the cash buffers, the severe penalties, it all comes back to this one simple but incredibly powerful concept: trust.
So why should you care about this whole unseen fortress? Well, because it protects your savings. It makes sure you can pay your bills and that businesses can keep running smoothly. It's the wall that stands between all of us and the kind of economic chaos a banking collapse can cause. At the end of the day, it's the bedrock of our financial confidence.
But here's the thing. The world of finance never, ever stands still. With digital currencies, with fintech startups changing the game, the very definition of what a bank even is, well, it's evolving. And this leaves us with a final, really crucial question. How does this fortress have to evolve? How do we build new gates for all this innovation without creating cracks in the walls that could threaten our trust? That's the huge challenge for the next generation of regulation.